What is inflation and how does it affect you? Every time we go shopping, pay bills, or plan our savings, prices seem to rise. This presentation explains what inflation really is, why it happens, and most importantly, how it affects your everyday life and financial decisions. What is inflation? Inflation is the gradual increase in the overall prices of goods and services over time. As prices rise, the value of money falls. This means the same amount of money buys fewer goods and services than before. Simple example. Let's understand inflation with a simple example. If a product costs 100 rupees today and inflation is 6%, the same product may cost 106 rupees next year. Your money hasn't changed, but its purchasing power has reduced. Why does inflation happen? Inflation happens for several reasons. Demand may rise faster than supply, production costs like fuel or wages may increase, or there may be too much money circulating in the economy. All these factors push prices upward. Types of inflation. There are different types of inflation. Demand pull inflation occurs when demand exceeds supply. Cost push inflation happens when production costs rise. Built-in inflation occurs when higher wages lead to higher prices. How inflation affects you? Inflation directly affects your daily life. The cost of food, fuel, education, and healthcare increases. Household budgets become tighter, and managing expenses becomes more challenging over time. Impact on savings. If your savings earn interest lower than the inflation rate, your money loses real value. Even though the balance increases, what you can actually buy with that money decreases year after year. Impact on income. When salary growth is slower than inflation, purchasing power declines. This means even with a pay raise, you may feel financially stressed because prices rise faster than your income. Inflation and investments. Some investments help beat inflation over the long term. Assets like equities and real estate often grow faster than inflation, while low-interest savings may struggle to protect purchasing power. How governments control inflation. Governments and central banks control inflation using tools like interest rates, monetary policy, and fiscal measures. Higher interest rates reduce spending, while lower rates encourage economic activity. Is inflation always bad? Inflation is not always harmful. Moderate inflation encourages spending and investment, supporting economic growth. However, very high inflation reduces savings, increases uncertainty, and damages the economy. Key takeaways. To summarize, inflation reduces the value of money over time, affects daily expenses, savings, and income, and makes financial planning essential. Understanding inflation helps you make smarter money decisions.